If you've been watching the Arizona housing market over the last few years, you know it's been a frantic scramble. But moving into 2026, the wild bidding wars and extreme volatility have leveled out into a much more deliberate structural expansion across the state. We spent the last few years staring down historically high interest rates in the 7% range. That panic has largely faded. Rates have settled into a steady baseline, hovering right around 6.3%. This new plateau has reintroduced the traditional rules of leverage. After years where sellers dictated every term, the momentum is finally shifting back toward negotiation and compromise. But this creates a frustrating contradiction. National headlines will tell you the market is perfectly stable. Yet if you look locally, buyers still feel priced out by those 6% rates, and sellers are watching their homes sit untouched for weeks. Using a pandemic-era playbook in this environment creates immediate friction. Ignore the current math, and you end up stuck in a cycle of failed negotiations, or you miss the window of opportunity to move entirely. Let's look at the actual data. Traditionally, a healthy Arizona market sat near a baseline of 35,000 active listings. During the 2021 buying frenzy, that inventory plummeted. Today, it's slowly trending back up, but we're still sitting at roughly 27,000 homes on the Valley market. Here is the anomaly. Even though we have fewer homes available than our historical norm, sellers are suddenly seeing a massive 30% month-over-month spike in canceled and expired listings. This is happening because today's buyers simply refuse to pay peak 2022 prices while shouldering 2026 mortgage rates. Because supply and demand have risen at roughly the same rate recently, we've settled into what is technically a slight buyer's market. There is no average Arizona housing market right now. Success or failure depends entirely on correctly diagnosing which specific microsegment you actually belong to. Let's start with the sidelined first-time buyer. Statistically, the median age for this group is now 40 years old. They've been renting or living with family to save cash, and their purchasing power is highly sensitive to that 6.3% rate. Their primary target zone is the sub-$400,000 tier. We're talking specifically about condos, townhomes, and smaller single-family homes around 1,200 to 1,500 square feet. There is a mathematical bright spot here. Inventory in this specific affordable segment is actually up 11%. And the price per square foot has retreated all the way back to mid-2021 levels. But there is a trade-off. Getting into one of these homes means you have to stomach a higher monthly payment upfront. To make the math work, buyers are using what we call concession leverage. Because homes are sitting longer, buyers can aggressively negotiate for the seller to cover closing costs or pay for mortgage rate buydowns. Securing these concessions requires flexibility. You win by targeting properties that have been sitting on the market for a few weeks, or homes that need minor cosmetic updates. For a financed buyer, trading a slightly higher base interest rate for immediate hard dollar negotiating power from a motivated seller is the only mathematical strategy that works in 2026.
Now, let's look at the current homeowner. Many want to move, but their expectations are anchored to the frenzied peak market of 3 years ago. If you price your home based on what your neighbor got in 2022, you are ignoring the reality of a 6.3% rate environment. Buyers will simply pass you by. Then there's the availability trap. In the current market, requiring a 24 or 48-hour notice for a showing is enough to make a buyer look elsewhere immediately. We tracked a 30% spike in canceled and expired listings from February to March 2026. These sellers completely failed to close. To avoid expiring, sellers must pivot by offering repair credits, rate buydowns, and immediate showing access. It is a difficult financial reality to accept, but your net profit margins will be noticeably lower than what your neighbors achieved during the pandemic.
Sellers must sacrifice maximum profit margins in order to secure the liquidity required to actually sell the property and move on with their lives. There is a third segment operating by an entirely different set of rules, the cash-heavy buyers. They are completely insulated from the friction of a 6.3% mortgage rate. A major economic driver is the massive influx of tech workers moving to the developing North Phoenix corridor to support growing semiconductor manufacturing hubs. Another major driver is out-of-state retirees paying cash for luxury active adult communities in areas like Oro Valley and Saddlebrook. Because they bypass the lending process entirely, cash buyers hold a unique market advantage. They don't need rate buydowns, making them highly competitive for the most desirable turnkey properties. Their trade-off is paying premium entry prices today, buying into established luxury amenities, and the promise of long-term economic infrastructure expansion. For the cash buyer, 2026 is strictly about securing a premium location and lifestyle, prioritizing long-term value retention over immediate bargain hunting. With these fragmented segments, we can build a definitive playbook to cut through the noise. Here are your next steps. The critical factor in your decision tree is financing. If you need a mortgage for the sub-$400,000 tier, buy now and demand rate buydowns. If selling, price realistically from day one and prepare to concede cash at closing. This environment favors diligent savers around 40 years old finally entering the market and cash-heavy relocators riding Arizona's economic boom. In this balanced environment, success is no longer a given. Outcomes are dictated entirely by the quality of a participant's strategy and their level of preparation. Shouldn't you just wait in your rental until interest rates drop to 5%? Here is the consequence of that choice. A significant drop in rates will instantly pull thousands of sidelined buyers right back into the active market. That sudden flood of renewed competition will instantly erase our current 27,000 home inventory buffer. You trade away your negotiating leverage, like closing costs, seller credits, and rate buydowns that make buying in 2026 viable. Success in the Arizona real estate market requires acting aggressively on today's mathematical realities, not waiting for the headlines you hope to see tomorrow.